chapter 18, we are discussing job order costing. So we're primarily focusing on manufacturing and service companies. We learned about manufacturing companies back in chapter 18 when we were dealing with the schedule of cost of goods manufactured, which was your homework assignment. So you got to see the way costs flow through a manufacturing company. Remember that a manufacturing company has 3 separate inventory accounts. So because of that, we apply the inventory formula 3 separate times. In this chapter, we'll get to see what the journal entries look like. And if I remember correctly, I think this is the last chapter where we actually have to deal with journal entries. But we get to see the journal entries for a manufacturing company. Now, there are 2 types, actually there's more than this, but for right now, there are 2 types of accounting systems that we can use to track our costs for a manufacturing company. And when I say accounting systems, I mean in terms of how we organize the cost and how the costs flow through the different inventory accounts. The type of system we use is heavily dependent upon the type of company that we're dealing with. And that type of company will be making different types of products. So if we're looking at a company that makes highly specialized products like building airplanes or building homes where each client has certain specifications and every job or every product is a little bit different, then that company will use what's known as job order costing. If we're looking at a company that makes highly uniform products where everything is pretty much the same, you can easily or distinguish, where you can't easily distinguish one from the other, so something like ketchup or tissues, those companies use what's known as process costing. If you are a BAT major or if you are an accounting major, when you get to cost accounting, you will see the accounting that is necessary for process costing. But right now, we're going to only focus on job order costing. So in this slide here, it sort of repeats what I was saying in terms of how you distinguish between job order costing and process costing, and it's all about the product that the company is making. So if it's a product where one unit looks like another unit, and it's some mass production, then we're looking at process costing. But if it's job order costing, then there are specific jobs or specific products that look different from the other. It's highly customized. The customer kind of gets to choose what their product looks like. So in looking at job order costing, we are still dealing with the 3 separate inventory accounts. The primary difference is now we have little subsidiary accounts to keep track of each customer's product. Each customer's order is called a job. So if you look specifically in the work in process inventory account, you will notice that there's job B15, job B16. Those are the subsidiary ledgers. And when I say a subsidiary ledger, what I really mean, we're keeping track of each job separately. We can add up all of those jobs at the end, and that gives us the total cost of work in process inventory. So we're still having our costs flow in to work in process in terms of direct materials, direct labor, and manufacturing overhead. But we filter those out to individual jobs. And then as we finish the jobs, the entire job or the entire subsidiary ledger is moved to finished goods inventory. And then once we provide the product to our customer, then we expense those costs through cost of goods sold, but again, as one job. Now, this slide here says in word form what the previous slide said in picture form. So if words work for you better, you can take some time to read this slide, but just keep in mind that we use subsidiary ledgers to keep track of each individual job. Now, let's talk about some of the source documents that we will find in job order costing. Remember that source documents are the pieces of paper or the electronic documents that give me information about my transactions so that I can do my journal entries. The first source document we're going to look at is the job cost sheet. Now, the job cost sheet keeps track of all of the costs associated with one individual job. So if you look at this closely, you can see that we have three major categories here: direct materials, direct labor, and manufacturing overhead. So there are some things that still hold true. And one of those things is that there are three basic costs associated with making a product: materials, labor, and overhead. I get to see all of these costs summarized on the job cost sheet. Each job has a unique identifying number so that I can keep track of who the job is for and whether or not I've finished it, and I can follow it throughout the accounting process. Now, in addition to the job cost sheet, every one of my major cost categories will have different source documents to help me keep track of what's going on within those individual categories. So in terms of materials, my point is materials has a source document. Actually, materials has a couple of source documents. So when a company orders materials and the materials come in, they are counted and then sent to the proper inventory department. When the inventory is sent to that department, the person that is responsible for receiving the inventory will fill out what's known as a receiving report. So he will clearly identify what's coming in. The receiving report serves as a source document for materials purchases. It shows what's coming in. The materials ledger card will keep track of everything as it relates to materials: what's coming in, what's going out. The specific source document that we use to keep track of what's going out is the materials requisition form. So I'm skipping ahead because I want you to see the materials requisition form. So here is the materials requisition form. If you remember, when we prepared the schedule of cost of goods manufactured, we had to compute direct materials used. The materials requisition form is the source document for direct materials used. Each requisition has a unique identifying number, again, so that we can keep track of all the materials that are coming out of the inventory department. And it's important that each materials requisition be approved by a supervisor. And we have names on here in terms of who received the material. And that's important because it limits the opportunity for people to steal the inventory. Without these forms, people can just walk in, take the inventory out, and there's no responsibility. But with this form, if someone said they took the inventory out, then I should be able to see that inventory flow to a job cost sheet. If I don't, then somebody's stealing the inventory and they're selling it or they're using it for their own purposes. So these source documents aren't just something that we use to help us do our journal entries, but they also help us safeguard our assets. So I'm going to go back for a second because I want you to see the materials ledger card. On the materials ledger card, we can see the receiving report, so that's inventory coming in, and then we can see the requisitions, and that's material going out. And the last block of information here, this is where we keep a running track of the inventory that we have. So the materials ledger card serves as a source document for raw materials inventory. And that brings us to our first journal entry. Oh, how I've missed journal. Haven't you missed journal entries? Oh, how I've missed journal entries. Here's the first one. So for this journal entry, this is the entry to record direct materials being issued into production. If you don't remember anything else I say today, please remember this. There is no separate account called direct materials. When we record direct materials, we debit work in process because direct materials used go directly into work in process. So if you're asked to do an entry to record direct materials being used, please don't debit direct materials. It's not an account. You need to debit work in process inventory, and then you credit raw materials inventory. Now, if you happen to look at the handout that I gave you, when you see this entry, I think it's entry number 2. I don't think I have the handout directly in front of me, or maybe I do. But if it's journal entry number 2, then I've combined that with the journal entry for indirect materials as well. So again, you can do this as one big entry, or you can do it as two separate entries, but we'll see that more when we do some problems at the end. All right, and we're going to slide 26, so we're almost there. We're almost to the end of today's session in terms of slides. Now let's look at labor, because materials had a bunch of different source documents. With labor, it's not as bad. So with labor, the source document for direct labor would be the time tickets. Now the time tickets tell me how long an employee worked on an individual job. Don't confuse the time ticket with the time sheet. The time sheet tells me how long the employee worked during the pay period on a bunch of different jobs. But the time ticket is the one that tells me how long the employee worked on one specific job. So the next slide shows me an example of a time ticket. So notice, just like a materials requisition, the time ticket has a unique identifying number. And I get to see the employee's name, which specific job they were working on, and I see how long they worked on this one job. This is the information, that $60, that is the information that will flow to the job cost sheet. Now, let's see our next entry. The same way, there is no separate account called direct materials. There is no separate account called direct labor. When we record direct labor, it goes directly into work in process. So we debit work in process, and then we credit factory wages payable, or salaries and wages payable. Or you can credit cash. There are a couple of things that you can do with that one depending on the problem. But usually the problem will be pretty specific in terms of telling you that, we haven't paid them yet. We are just incurring the costs. But the important part here is that the direct labor cost gets debited to work in process inventory. And also on the handout that I gave you, when you go back and look at that, you're going to see direct labor and indirect labor recorded together, but in your book, it does it as two separate entries. So we'll eventually get there. Now let's talk about our last product cost, which is overhead. Remember that overhead includes those product costs that we can't directly trace in terms of materials and labor. So it doesn't fit into the other two categories, but I need it to help me make my product. Examples would be indirect materials, indirect labor, factory depreciation, taxes on the production facility. So again, all those costs that are associated with making my products, but they don't fall into the category of direct materials and direct labor. All right, so in terms of overhead, again, overhead does not come in uniformly throughout the year. So what does that really mean? I could finish a job in January, but the tax bill may not come in until July. Am I going to wait to bill my customer for that job until I get the tax bill so I can know the correct amount to include in my client's bill? No, it's the same thing for something like a water bill that only comes in quarterly. I may use water to help me make my products, but I don't have time to wait for that bill to come in before I send my client a bill. So in those situations, overhead is usually estimated. So the amount of overhead that we charge for each job is based on an estimated rate. I still record my actual overhead costs as they come in. And at the end of the period, I will compare my estimate to my actual and make adjustments. On this slide, and it's a little difficult to see, but I think it's repeated again on the next slide, we use what's known as the predetermined overhead rate to help us estimate our overhead. The predetermined overhead rate is found by taking our estimated overhead costs, which will be given to you in a problem, and we divide it by some estimated activity. So we are assuming that there is an activity that drives or increases overhead costs. In the real world, the hardest part of this is finding the right activity. It could be direct labor hours. It could be machine hours. It could be the number of units that we produce. It could be a bunch of different things. From a classroom perspective, the problem will tell you what the activity base is. From a real world perspective, we have to rely on our engineers and our production managers to help us determine what causes the overhead costs to increase. The primary thing that I want you to take away from this predetermined overhead rate is that we find it using estimates. So we have to estimate overhead. And then we divide that by the estimated activity. For the company that we are dealing with and the example that we are seeing over and over again, Road Warriors, they are basing the overhead rate on direct labor cost. So I have to use my estimated direct labor cost as my denominator. All right, so in terms of overhead, the rate has been calculated for us. So assuming there is a certain amount of estimated overhead costs and there was an estimated activity base of direct labor costs, the numbers aren't explicitly shown here, but when we do the calculation, we determine that overhead is 160% of direct labor. So in dealing with overhead, we find our rate, and that rate is based on estimates, and then we multiply that times the actual direct labor cost. So for all of our individual jobs here, each one of them had a direct labor cost. We multiply that times the predetermined overhead rate to give us our estimated overhead or our applied overhead. So when you see the word applied, that just means the estimated overhead that gets charged to our jobs. Because this gets charged to our jobs, what that really means is it goes directly into work in process, just like all of my other product costs. So direct materials, direct labor, and my applied or estimated overhead all get recorded in work in process when they happen. Now the credit this time is in the factory overhead account. So there is a separate account for factory overhead, not for materials, not for labor, but yes, for factory overhead, there is a separate account that we use. All right, so in terms of the actual overhead costs, as they come in, we have to record those as well. And when we record actual overhead costs, this is where we debit factory overhead, and the credit is based on what we are recording. So if we're talking about indirect materials, then yes, we debit factory overhead, but we credit raw materials inventory. This is the one where I like to do one big entry, because usually when we are issuing materials into production, the materials are both direct and indirect. So if you look at my handout, to deal with the direct materials, we debit work in process, but to deal with the indirect materials, we debit factory overhead. The credit still goes to raw materials inventory. So we'll see an example of that one in a second. For labor, it's sort of the same deal. When we record our labor costs, it's either direct or indirect, so I like to do that as one big entry. So for the direct labor, we debit work in process, and for the indirect labor, we debit factory overhead. The credit can go to salaries and wages payable or factory wages payable. In some cases, it could go to cash. You just have to look carefully at the problem. And then for all of the other factory overhead items, like whether it's rent or utilities, we could really see a bunch of different credits here, which is why I like to use the term various accounts. So it's a generic term that's sort of my junk drawer for all of the different credits. Because in the real world, I'm going to easily be able to tell what my credits are. But sometimes in the classroom, it's not clear. So instead of listing all of those accounts and making up numbers, I use the generic term various accounts. So if you see my handout for actual overhead costs, yes, we debit factory overhead, but we credit various accounts. Now, let's do some problems together where we can see some of these journal entries played out. So I want to do with you quick study 19-4. And I'll give you the page number once I get there. And it's on page 709. Quick study 19-4. During the current month, a company that uses job order costing purchases $50,000 in raw materials for cash. It then uses $12,000 of raw materials indirectly as factory supplies and uses $32,000 of raw materials as direct materials. And we need to prepare journal entries to record these 3 transactions. So even though these are 3 transactions, I'm only going to do 2 journal entries. If you want to do 3 separate entries, that's perfectly fine. But I like to combine the entry for direct materials and indirect materials. So first we have to deal with the purchase of raw materials. This is just like the purchase of inventory. This is not really anything new. Let me label this as quick study 19-4 so that you know when you go back and look at it. And so when we purchase raw materials, we debit the inventory account, raw materials inventory, for $50,000. And then we credit, let's see, we purchased it for cash, so we credit cash for $50,000. Now, I'm putting the description so that when you go back and look at these, you understand why we debited what we debited and credited what we credited. But in terms of a test, I am not going to take off points if you don't have a description. All right, let's look at the next transaction. In the next transaction, we used $12,000 of raw materials indirectly and $32,000 of raw materials directly. In this entry, the materials are being issued into production. And when materials are issued into production, if they are direct materials, we debit work in process inventory. So we're going to debit work in process inventory for the $32,000. The indirect materials get debited to factory overhead. All actual overhead costs go on the debit side of the factory overhead account. And then the credit is raw materials inventory because that's where we're taking this from. Okay. Okay, let's do another one. So, do quick study. What do I have written down? 19-5. Several written down here. So we're still on the same page, we're just moving down. So let's do 19-5. And quick study 19-5 says, during the current month, a company that uses job order costing incurred a monthly factory payroll of $180,000. Of this amount, $40,000 is classified as indirect labor, and the remainder is direct labor. We need to prepare entries to record these transactions. So for this one, we're only going to have one entry because I am going to combine the entry for direct labor and indirect labor. Quick study. Direct labor. goes directly into work in process inventory. So I'm debiting work in process inventory for the portion of my factory payroll here that is direct. And they don't give me that number explicitly, so I'm going to take the 180,000 and subtract out the indirect portion to find the direct portion. So when it comes to labor, and even when it comes to materials, sometimes you have to be careful because the problem will not explicitly give you the numbers. So you do sometimes have to be careful. In this example, I was given indirect labor, but I was not given direct labor. But they gave me the total, so I can subtract to find the direct labor portion. The indirect labor will be debited to factory overhead. And my credit can be factory wages payable or salaries and wages payable. Either one of those is acceptable. All right, there is one more that I want to do with you. And that one is Quick Study 19-6. And this is going to help us see the predetermined overhead rate. Because sometimes when you talk about the predetermined overhead rate, it kind of makes sense, but it makes more sense when you actually see the calculation of it. So in Quick Study 19-6, a company estimates the following manufacturing costs for the next period. We have direct labor, and we have direct materials, and we have factory overhead. We need to compute the predetermined overhead rate as a percentage of direct labor, then as a percentage of direct materials. Of course, we're supposed to express our answers as percentages. So when we calculate the predetermined overhead rate, we have to remember, first of all, that we're using estimates. Overhead cost is always on the top. So overhead cost is always my numerator. My denominator is what can change based on the problem. So in this problem, my denominator will first be direct labor costs, and then it will be direct materials costs. All right, so we're finding the predetermined overhead rate, and we abbreviate the predetermined overhead rate as that POHR. So when you see me type that, or if you see that in the answer key or throughout the chapter, we're just talking about that estimated overhead rate. Now, overhead is always on the top. So I'm going to take that 117, and it will ultimately be divided by direct labor costs first. So I'm going to take 117 divided by the 468. And because I'm typing this in such a crazy way, I have to go back. 468. We want it as a percentage. So it is 25%. And this is for direct labor. Now, what if we didn't think that direct labor cost was a good activity base? What if there's something else that drives overhead costs that's a better estimate? So let's pretend now that we're going to use direct materials costs. So now we take the predetermined overhead rate, and we find it by taking our overhead cost. Overhead always goes on top. And now we divide it by our materials cost of $390. that's how we find the predetermined overhead rate. So what I want you to keep in mind is that overhead costs always go on the top and the activity is on the bottom. The activity is the one that's going to change. But with all of these numbers, make sure you're using estimates. This problem is pretty straightforward. And some of those other problems are going to give you a ton of different numbers. Some of them will be actual, some of them will be estimates. You have to know the right numbers to pull. And we're using estimated numbers for the predetermined overhead rate. All right, I said that was the last one, but I guess I didn't tell the truth because I really want to do quick study 7 with you because yes, we know how to calculate the rate, but that's not the number that we need for our journal entry. We use that number to multiply it times the actual activity to find the number for the entry for overhead being applied to our jobs. So I really want you to see that before I give it to you for homework. All right, so one more quick study 9-7, and I promise you that's the last one. At the beginning of the year, a company predicts total overhead costs of $560,000. So there's my estimate. The company applies overhead using machine hours and estimates that it will use 1,400 machine hours during the year. What amount of overhead should be applied to job 65A if that job uses 13 machine hours during January? So in this problem, I'm going to add to this problem just a little bit because I want to actually do the entry for the overhead being applied to the jobs or that job. Before we can do the entry, we first have to find our predetermined overhead rate. Once we find that rate, we're going to apply that rate to the actual hours for one specific job so that we can do our entry. So let's first find the rate. In this example, the predetermined overhead rate is based on machine hours. So I'm still taking my estimated overhead cost first, and I am dividing that by my total estimated machine hours. And we see that the number is 400. So this is important too, because the predetermined overhead rate will not always be a percentage. It will not always be a decimal. It could be a whole number. It just depends on what my activity base is. So I don't want you to look at that number and say, oh, it's not a percentage, that's wrong. No, it depends on what my activity base is. So now I'm going to take that rate, that predetermined overhead rate of 400, and I'm going to apply that to my one job. Job 65A used 13 hours during January, so I'm going to multiply that 400 times 13 hours. And it will probably help you out if I use dollar signs so that you would know that this is a rate per hour. So let me make that clear. This is 400 times 13. So to add on to this problem and to do the entry for the overhead applied to this one job, I'm going to debit work in process inventory. And the credit is going to go to factory overhead.